Europe's economy is entering a delicate phase marked by a cautious balance between showing inflation modest growth and fiscal pressures on governments that are trying to invest in the future while avoiding unsustainable debt. At its most recent meeting, the European Central Bank decided to keep interest rates unchanged, reflecting both progress in reducing inflation and concerns about the fragility of growth. For 2025, euro area GDP is projected to expand by roughly 1.2%, slightly better than earlier estimates of about 0.9%. These models upgrade signal some resilience in domestic demand and investment, but the long-term outlook remains restrained, with forecast of growth easier to around 1 in 2026% before recovering slightly to about 1.3 in 2027. This pattern suggests Europe is avoiding recession but still faces a prolonged period of subdued expansion. Inflation is at the center of the policy debate. Headline inflation across the euro area has drifted close to the USBC's medium-term target of 2%. In August, it registered around 2.1%, a small increase from 2% the previous month. That may look like stability, but beneath the surface, inflation dynamics remain complex. Core inflation, which excludes the more volatile energy and food components, is expected to hover at roughly 2.4% through 2025 before gradually easing to just under 2% in 2026 and 2027. This is important because the ECB's policy decisions are more sensitive to core inflation trends than to headline figures. Energy prices remain volatile, shaped by geopolitical uncertainty and fluctuating demand. Food inflation, while slowly moderating, is still a source of pressure on household budgets. Wage growth, once a major driver of inflation, is starting to moderate, but it is not yet clear whether it will be stabilized at a level of consistent with 2% inflation over the medium term. The fiscal backdrop adds another layer of complexity. Governments across Europe are caught between competing pressures. On one hand, there is a need to stimulate investment in infrastructure, digital transformation, green energy, and defense. On the other hand, public finances are already stretched, with high debt levels and deficits that raise questions about sustainability. Germany, the Eurozone's largest economy, is at the center of its debate. Its constitutional debt brake limits structural deficit. But policymakers are actively discussing reforms to allow more flexibility in financing crucial investments. A government-appointed commission has already begun working on proposals to modernize this rule, recognizing that the existing framework will be too restrictive for an era that demands large-scale spending on energy transition, defense commitments, and digital comprehensiveness. Other countries like France and Italy face similar tensions with fiscal consolidation goals, often colliding with political pressures to protect households from inflation and to invest in long-term growth. The risks facing the euro area are considerable. Trade tensions and geopolitical development remain a major threat, whether through tariffs, strained EU-US relations, or competition with China. Disruptions to energy supply chains or sudden spikes in commodity prices could quickly feed back into inflation. At the same time, financial stability is not guaranteed. Governments with high levels of debt are vulnerable to shifts in investor sentiment. Rising long-term yields make debt servicing costlier, potentially limiting fiscal space. The bond market's tolerance for deficit is not infinite, and an unexpected loss of confidence could trigger turbulence reminiscent of earlier debt crises, even if Europe's current situation is less acute. Against this backdrop, the ECB has adopted what is described as a data-dependent stance. This means that future decisions on interest rates will be guided strictly by incoming data rather than pre-announced commitments. The central bank is not promising either cuts or hikes, preferring instead to keep flexibility as conditions evolve. They said the ECB continues to stress the importance of governments complementing monetary policy with structural reforms and growth-friendly investments. Policymakers argue that boosting productivity, competitiveness, and advancing the green and digital transitions are essentials for lifting Europe out of its growth trap. The central bank also emphasizes that fiscal policies should be more targeted, avoiding blanket subsidies or targeted spending programs that risk fueling inflation while doing little for competitiveness. The significance of its delicate balancing act extends far beyond central bankers and finance ministers. For investors, the euro area outlook shapes capital allocation decisions. Bond markets in particular are sensitive to both ECB policy signals and government fiscal choices. If deficits rise and reforms stall, yields could climb, pressuring governments and crowding out private investment. On the equity side, sectors tied to interest rates, such as real estate and banking, remain highly responsive to monetary policy signals, while energy and utilities are more exposed to inflation dynamics. For households, the story is felt most directly through the prices and wages. Inflation all or near 2% provides relief compared to the double-digit rates of 2022. But lingering pressures in food and services erode purchasing power. Whether wage growth can keep pace will be a defining factor for consumer sentiment in 2025 and beyond. The stakes for governments are equally high. If fiscal austerity is pursued too aggressively, there is a risk of undercutting fragile growth and fueling political discontent. Yet, if spending remains too loose, inflation could reaccelerate on markets, could punish excessive borrowing. The challenge is to calibrate policies so that they support investment without undermining fiscal credibility. Germany's debt brake reform discussions will serve as last test case watched closely across Europe. If Berlin managed to strike a compromise that allows higher investments while retaining fiscal discipline, it may set a model for other euro area countries. If not, the risk is a patchwork of inconsistent approaches that leave the eurozone vulnerable to asymmetric shocks. Looking ahead, several factors will be critical to monitor. First, the ASBC's quarterly projections will provide updated views on inflation and growth, and this will heavily influence market expectations about rate cuts or further pauses. Second, national budgets and reform plans in major economies like Germany, France, and Italy will show how seriously governments are balancing investment needs with fiscal rules. Third, global shocks, whether energy disruptions, geopolitical conflicts, or new trade restrictions, could shift the entire policy landscape in a matter of months. Fourth, developments in the labor market, particularly wage trends and unemployment rates, will help determine whether inflation pressures persist. Finally, the health of the bond market will serve as a barometer of confidence in European fiscal policy. If spreads between core and peripheral eurozone bonds widen significantly, it could signal renewed fragmentation risks. In short, Europe is navigating a narrow path between inflation control, modest growth, and fiscal stability. The ESBC has paused its cycle of rate adjustment for now, but future decisions remain uncertain and data-driven. Governments are under pressure to invest long-term priorities, yet they face legal and political constraints that limit fiscal space. The risks are real. Geopolitical tensions, volatile energy markets, and fragile debt dynamics could all derail the current cautious optimism. Still, with inflation meeting target and growth projections slightly improved, policymakers see a chance to stabilize the euro area economy, provided reforms are not delayed and fiscal choices remain credible. For households, businesses, and investors alike, the coming month will test whether Europe can finally turn the corner from years of crisis management toward a more sustainable path of stability and gradual growth.